All right, y'all, I'm gonna get us started. Let me turn this fan off. I'm sure we'll have some more people in because the line's kind of long back there, but thank you all for coming. If you're in the back, just, if you can't hear me, just like holler or, raise your hand. So yeah, there's some seats and you can even sit at this table if you want to, because we got a tripod. So thank you, Nathan, for that. So today we're going to be talking about how to invest in small multifamily. A lot of people in the group have been requesting this one and have requested it for a while. And so we actually had a recent deal that we just got to the end of the road on. We bought it last year. We did a bunch of improvements. We raised the rent. So we just went through this full process on a 17 unit property. So I thought this would be a good time to share our experiences, the good and the bad about it, and then just give y'all some stuff that you can take and learn from and maybe do some of your own small multifamily deals. So why small multifamily is good is because it's kind of a gap between single family investing, which is very easy to get into, relatively speaking, and big multifamily, which you kind of have to have a lot more resources and preparation and team, and it's a really big and different business model. And so small multifamily kind of bridges the gap where you get a lot of those same, I call them levers, that you get to pull, where you can make some really big moves happen in equity and all that stuff, but you don't necessarily have to have the resources, such as tons of capital, that you have to for the really big multifamily. So it's a really good, not even a stepping stone, because maybe I'll get into big multifamily one day, but I really love these small multifamily. They're too big for a lot of single family investors to do, so there's not as much competition. And then the big guys, they don't want to mess with this. They don't care about a 17 unit property. So it can be a really good niche. This is an outside view of part of the property. There's another building over there. There's another building across the street. But we're going to cover a case study on it. So I'm going to share the numbers and everything about this deal with y'all. So we'll open it up and you can ask any questions because we have recent experience on this one. And then we're going to talk about how to add value. And so I'm going to actually do an exercise where we can look at, if we were analyzing a potential deal, what are the things you need to look for to see if you can do a value add? And if you can, how could that potentially affect what the property would be worth? So those are the things you need to know if you're considering doing small multifamily is, what numbers can I affect and how will that affect the value? That's how you do a value add. So how to find the value of a commercial property, which these are considered commercial properties, is it's not like single family. You need to know these two numbers. You're not just pulling comps, although we just had an appraisal done and they do factor in comps somewhat, but they actually use comps to look at these numbers. So the NOI, the net operating income, and the cap rate. So net operating income is basically like a profit and loss for the property. It's as if that property is its own business and it's a profit and loss for that business. And does anyone know cap rate? Can anyone explain cap rate to the group? Cap rate's kind of tough. So what cap rate is just basically the expected return for a property. So if it's a 10% cap rate, which we're going to use in the examples here a lot today because it's an easy number, 10. If it's a 10% cap rate, that means buying it at that price, the investor can expect a 10% return on their money. That's unleveraged. Now, if they leverage it, the return can go up. So that's what cap rate is. So how to find the value of a commercial property is very simple. You take this number, you divide it by that number. So we're going to start looking at how do you add value on multifamily. If the net operating income is higher, that's going to increase the value of the property. And if you're dividing it by a cap rate, if the cap rate is higher, that's actually going to make the value of the property less. because you're dividing by more. So the lower the cap rate, the higher the value you're going to get on the property. So those are the two things that you can affect, and they each have, well, NOI has a lot of line items that we'll get into, but you affect those two things, you add value to a multifamily property. It's simple, not always easy. All right. So let's look here at how to find the net operating income. Like I said, it's kind of like a profit and loss statement. So if you're familiar with business, then you know about P&Ls. So you take the income of the property, you subtract out all the expenses. So we've got property tax, insurance, maintenance expense, which maintenance could include lawn maintenance. It could include make-readies when you have to turn a unit over after someone moves out, or it could just be fixing plumbing or general maintenance. So you could break that up, but that's all included in maintenance. Property management, marketing, administrative fees, utilities, these are all things that go into the net operating income. So you just take your income from the property, subtract out all your expenses, you multiply that by 12 to get your annual net operating income. So that's important. When you're finding the value of a property, it's based on the annual NOI divided by the cap rate. So those are your expenses. Pretty simple. So if you want to affect the value, if you want to do a value add on a multifamily, you either need to raise the income or reduce any of these expenses. And it has a multiplication effect on the value of a property, which you'll see here in just a bit. Any questions on that before I move on? Cool.
Yeah.
All right. So no one raised your hand with what cap rate is. So I'm guessing you probably don't know how to find the cap rate on a property. Does anyone want to take a guess at how you figure out the cap rate? No?
Depending on how risky the investment is.
That might be something that is considered as one small factor. You look like you're cooking something up. Nathan, what do you got?
I can't remember because I only had to do this once.
Okay.
But I think it's, is it pro rata income or is just the potential income divided by vacancy rate?
Divided by what?
Vacancy rate?
No. So that goes more into the NOI. Up here, market rent times occupancy rate is more of what goes into that. So this is definitely a trick question. Finding the cap rate is more of an art than it is a science. So there are a lot of factors like the one that Samuel talked about that kind of play into it somewhat, but figuring out exactly how much weight they have towards finding the cap rate is kind of an art. And this is probably one of the hardest things about multifamily investing is figuring out what your cap rate's going to be, because there's not a lot of data on this. You have to know very specific places to find the data, and cap rate is huge. So, going back here, if you miss your insurance cost and you're just way off in your numbers, that may be $1,000 a year, $2,000 a year, right? So that might affect the value of the property by $20,000. If you get the cap rate off by a few percentage points, that could potentially alter the value by hundreds of thousands of dollars on the property. So cap rate is super important. It has a huge impact and it's hard to find. So like I said, it's not an exact science, but I am going to attempt to make it somewhat of a science by making like a first grader's art right here. So here we have cap rate. Here we have desirability, okay? So the cap rate is highest on the properties that are the least desirable. And then the more desirable the properties are, the cap rate goes down, which we know that if a cap rate goes down, value goes up. If a cap rate is higher, value is lower. So the more desirable the property is, the cap rate will get lower and lower, the value will get higher and higher. So that's kind of the baseline principle. Now, where does your property fall on that spectrum? It's hard to know. When I'm analyzing mobile home parks, those don't appeal to as many investors as apartments do. And so a small mobile home park, like under 40 units, it's probably going to be somewhere in this range. It's going to have a higher cap rate because it appeals to less buyers. Now, a 50 unit mobile home park, that's going to appeal to some more buyers. That might be over here. You might underwrite it with a little bit lower cap rate. If it's a 100 unit apartment building, that's going to be way over here. That's what everyone wants. There's a big buyer pool. There's lots of money. So the cap rate is going to be lower on that than it would on a less desirable property. So with what we're talking about with small multifamily, it's going to be kind of somewhere in this mid-range. Is that it is desirable, but there's not a huge buyer pool like I talked about, which for investors, if you're a single family investor, there's not a lot of other single family guys doing small multifamily. So moving into that, it's not as desirable, but there's more opportunity for you. So it's kind of the balance. Now, how I'm going to turn this a little bit into science is because you got this water here. This is the tide of interest rates, right? Now, if I had an exact formula, I could tell you, okay, you take the prime interest rate, which today is 8%, and you add on 1.5% on top of that, and that's your cap rate. And then we would know cap rates are 9.5% right now, but they're not 9.5% right now. It depends on the property. But this little yellow floaty here kind of floats up and down, and so our green line is attached to the floaty. So the principle still exists that the least desirable properties are going to have a higher cap rate. The most desirable ones are going to have a lower cap rate. But that whole line is going to float up and down with the tide of interest rates. And so the general principle, along with desirability, is that if interest rates go up, cap rates are going to go up too. If interest rates go down, cap rates are going to go down. So this green line is going to shift up or down based on the interest rate environment. And that's kind of the best model I can put together about figuring out cap rates. It is related to interest, it is related to the property, it's related to how desirable it is, but it's hard to pin down exactly where it falls on that spectrum, especially in a changing market, which I'm going to show you here in just a second, the appraisal that we got back. But yeah, it can be kind of hard to pin down. Any questions on cap rate?
I don't think so, but just now, since our record, I think that, so I talked to, what's his name, your house manager, Brady Collier, and he told me that the major consideration for bathrooms and also the height of the unit. So in Lubbock specifically, if you have like a 40-unit tall building, there is not say a 40-unit tall building plus that is 5% market rent. Most people like, individual flats, I think we call it workforce housing units, where that's individual bathrooms, almost separate little houses.
And so what did he say about that information?
Well, he said that as far as looking for market rent houses, it's all going to be in that Southwest workforce housing units.
Is the highest?
It's, yeah, they're building like, I think 3 more next couple years.
Cool.
Just because that's, think about it, for a typical producer now, expecting levels, they're like, 28 to 24, 30 something. And neighbors aren't going to move into a place because they want more space. Versus, you have a typical apartment building, you have very little space, so it's not in your own bathroom. So the highest desirability from that aspect is, simply single family, like they have off University of 114, that kind of part.
Yep. So this is a very rough way of finding cap rate, but I just want y'all to understand kind of the principles behind it. But don't buy a multifamily property based on, hey, I think the interest rate's right here and it's kind of desirable. It should be right about here. Don't do that. You need to actually do your due diligence and try and find the cap rate. So this was our appraisal that we got back. Every single banker that I had a new conversation with over the last 6 months, I try to slip in a conversation about cap rate. Like, hey, what kind of cap rates are y'all seeing? We talked to the appraiser that did this before they did the appraisal, and she just needed to get access and asked me some questions about it. I said, hey, before you go, what kind of cap rates are y'all underwriting these deals at right now? So trying to just get a pulse on the market is actually one of the best ways you can figure this out. So having this data for us is huge because we underwrote this at a 7.5% cap rate when we bought it, and that was a year ago. And we thought it was fairly conservative a year ago, which it was. But they actually came in at an 8% cap rate on this property. So again, as cap rates go up, value goes down. There's some comps they pulled. What I was saying earlier, in multifamily, you're not pulling comps to say, oh yeah, this house looks like this house. They're the same size, so they're worth the same amount. They're looking at the annual rent, the net operating income, and then the cap rate that those sold at. So that's the info they're using from these comps. So you've got cap rates, and these were all the way back from May of 2021, all the way, and the latest sell was August of 2022. But you've got cap rates as low as 5.41% and as high as 8.67%. So the average of all of these comps, cap rate was 6.79%. And when you look at these, ours is 17 units, so it's along the lines of the smallest one up here, which had a 7.6% cap rate. And so ours is probably more desirable. This was built in the 1940s. Ours was in the 80s. Ours is a lot newer. Ours is in a really good part of town by Milwaukee and 19th Street. But that was in August of 2022, which we actually started trying to refinance around that time. It's just taken a long time. So be ready for this to be a little bit slower than single family. But had we refinanced then, we would probably have gotten maybe a 7% cap rate because ours was a little more desirable than that property. But what they put in here, even the appraisal company doing their little art strokes here, they said, well, there's market forces such as higher than usual inflation, continued increases in interest rates. They're causing upward pressure on cap rates. So you know what? We're going to use an 8% cap rate here, even though the average was 6.79. So, which I expected it to come in about 7.5, came in at 8%. So they're being kind of conservative. Appraisal companies don't want to underwrite a bad deal and then have a lender come back and say, you know, what the heck? You told me it was going to be worth all this much, and now we're getting the property back and it's not worth that. So they always kind of cover their tail. They're a little conservative. But, you know, this information right here is really good because now we can take this and use it on other properties that we're analyzing that are similar. Okay, 8% cap rate right now. If this is a long-term project, maybe we look at a 9% cap rate because cap rates, as you can see here, you'll see them in the slides if you don't have good vision when I send it out because this is kind of small. But they've gone up. They've gone up as interest rates have gone up. You have a question?
Yeah, I'm assuming higher cap rate is better?
Higher cap rate is gonna lower the property value.
Right, but I mean, like, all in all, like, is that better for you, or?
No.
Okay.
No. So the higher the cap rate is, they're gonna appraise the property for less money, even at the same income level. And so higher cap rate, lower value, lower loan amount. So I'd recommend, if you're looking to get in a small multifamily, try and find recent appraisals from people who have done a project like this. Talk to appraisers, talk to bankers, because they'll see a lot more of these appraisals come across their desk. And that's probably the best source.
Did you get all this information from a bank or an appraiser, or did you evaluate each one of these properties to put this together?
Are you talking about this right here? This was our appraisal. This is our actual appraisal we just got.
Provided to you.
Yes.
Okay.
Yes. Which, when we underwrote it, I kind of did the same rough thing. I called around people that I knew were in multifamily. What cap rates are you seeing? They said 5.5%. Thank God I underwrote it at 7.5% because I would have been, you know, if I would have paid those prices, I would have got a bad deal out of it. So I did the same thing, but it's just, okay, what is it actually going to come in at once you finish the project? All right. So back to the property that we just did. Share some more details about it. So I know everyone wants to know, where do you find these deals? This one was a texting lead. So someone on my team, there's no one on my team named Jessica, but someone named Jessica texted the owner because that's just a very inviting name. You know, If Austin sends you a marketing message, you'd be like, screw you, I don't want to talk to you. But Jessica, you'll at least be polite to her. You're like, you know, maybe she's decent looking, you know, maybe she's whatever. Like, I got long hair at least, so Jessica texted him, and this one actually slipped through the cracks, so I found this one on follow-up. So I was going through our system. We had texted him, and he said, yep, I'll sell it for, what was his price? $750,000 or something. And I thought this was just a single family home because from the Google view, it showed the long building from the short side. So I was like, okay, he's just trolling us. I followed up with it. I said, yeah, you're messing with us, right? He's like, no, I'd sell it for that price. And so I went and looked at it, and he said, yeah, it's 17 units. I'm like, oh, okay. He legitimately answered our text message and wants to sell the apartment building. Cool. So you can find these through all your marketing channels. It just comes down to what list you're pulling. So if you want to find multifamily properties, pull a list of multifamily properties. So it had 17 units, still has 17 units, plus a laundry room. One of these was a 2-bedroom, 2-bath. I believe it might have been a 2-1, but I think that was the 2-2. And then 16 units were 1-bedroom, 1-bath. They were rented for $500 a unit. This was 1 year ago. Okay, that's pretty cheap, right? They had 4 to 5 vacancies, and it was professionally managed. It's by a reputable company in town that they got a great reputation. I'm not going to throw them under the bus because it's not about them. It's about the fact that no one is going to care about your property as much as you will. And so this guy that owned the property, now he bought it for way less than he sold it to me for. So he also did a value add. He made money on the deal. He was super happy. And so what he had done, he updated the exterior. He did the interior on a couple of units. So he kind of did a little bit. So he did some value add. He gave it curb appeal. But they had 4 or 5 vacancies at $500, which is cheap. And so that was kind of a red flag on this deal for me because I said, their rent is $500 and they have this many vacancies and it's professionally managed. And I'm like, is it even possible to raise the rent on this property? So that was probably one of the hardest questions to answer along with cap rate was, will my plan to raise rents here even work? Like, or is this value add just going to totally flop? Because I thought, this is a professional, that rent is cheap, there's a lot of vacancies. So that was really tough. I had to do a lot of due diligence on the rental market. By the way, these photos are some of our after photos. They're not what it looked like when we got them. That door looked the same, but. So we bought it for $645,000. I got it under contract at $700,000. So a little bit off of what he was asking. I was told it was in perfect condition. We went inside, we saw some not perfect condition. So we had to renegotiate, which was I hate doing, very painful. But we did it, got it down to a price that worked for both of us. Rehab budget was $155,000, so total cost was about $800,000 on this property. So we kept some tenants, we moved them around. All of the renovations took us somewhere between 6 and 8 months, which, like I said, it only had 4 or 5 vacancies. So we had people locked into leases there that we had to somehow get to agree to us to renovate their unit. Not advised to go into someone's unit while they're living there and do a full renovation on their unit. Not advised at all. And so this was actually a really good logistical challenge for us to be able to solve because it kind of helped us with some of these other deals that we've done lately. But what we did is basically we took the good tenants, we started working on the vacant units first, and as we would fix them, we would tell them, hey, look, this property is going to be improved. It's going up and it's going to get nicer. It's going to be a nicer community and rents are going up. And so whenever your lease expires, your rent's going to go up as well. Everyone's going to be on this new rent amount. So you have the opportunity, if you want to take one of these brand new renovated units first, you can actually move into that unit. We'll get you on the new lease and you'll pay the new rent rate. But when it comes time for us to renovate yours, you're not going to get kicked out. You can get into it while there's still a unit available for you. So that worked really well. So we were able to just get people that had leases in place to increase their rent, move into the nicer units because they didn't want to have to move out of the whole property. So renovation was actually fairly quick, knowing that we did almost every unit in there. And the lease up took longer because we also had a professional manager at the time. And we've taken it in-house since then. But that took 3 to 4 months. That's longer than it should have taken. But that's how long it took for us to get it where it needed to be. It's one of the kitchens there. I mean, if you look at that, it's like, that's not that fancy. How did you do a value add? I'll show you the pictures in a minute of what it was like before. So our new rents, we came into this thinking that we could get $595 and that would be pushing it. And that was just because we were kind of uncertain because of the vacancy and the cheap rent. Like, we think we could probably get more than that, but we're just going to say $595 a month because we don't really know. Like, is there something wrong with this property? So all the 1-bedroom units, we're getting $700. All the 2-bedroom units, we're getting $800 to $825. So our market rent right now is over $12,000. And when we bought the property, it was $8,500. So that's a huge spread. That's almost $4,000 difference. Let alone, not to mention, our vacancy is a lot lower. Theirs was higher. So the spread was actually bigger than $4,000. But I'm going to show you all in a little bit how that can drastically increase the value of a property just by having better rents. That's how multifamily works.
Real quick, Austin, what is the square footage of your one?
They're much, how much are they?
340.
I think that's small.
Okay, for unit 17 specifically.
That one is. So they must vary. So yeah, they vary, but they're a lot less than 700 square feet. So we're renting it, I don't know, like $1.4 a square foot, I think. All rough numbers, but yeah, they're not very big.
And they're not studio apartments, right? They have like an actual.
They have a bedroom. It's very small. Everything's very small, but they have a kitchen, living room, bedroom, bathroom. So yeah, this was one of the units. This was actually the first one I walked in. So we got it under contract. I go in there, I'm like, okay, everything's perfect, but I'll just go do an inspection anyways. Smoker lived here. All of this, you can't see it. It's like brown and then orange and then yellow and then tinted white. So that fan was just circulating his smoke like crazy. So that was the first unit I saw. So I was like, okay, this is going to be a much bigger project. This was a bathroom. You can't see it, but that's exposed. It's not sheetrock, but it's a different type of, I think it's maybe hardy backer, but it's exposed and no caulking, and it's just, their unit was an absolute mess. I couldn't find pictures that did it justice, but some of them, most of these units were kind of similar to this. So this is what some of our updates look like. It's just presentable and clean. We didn't go over the top making these super nice apartments because that would have been a waste. And that's something you need to know if you're going to do a value add. Just match it to the niceness of the rent comps. So this is what the rental comps look like, and this is what we needed to get it to rent it for $700 per 1-bedroom apartment. And then bathroom, we used the plastic tub surround, the pre-made one, but it just looks clean. You see that picture, like, oh, yeah, that's clean. That's, I don't see anything wrong with it. And really, that's all we needed to do on this one.
So you had to do all 17 units like this?
There were a couple that were done, partially done, but most of them we did ourselves.
So it's about 10 grand per unit then? What the numbers at?
Yeah. A couple other things we did to add value. So we converted 2 of the units to 2-bedroom units. So there were a couple of them, and this is even in a house. You can apply this for adding value. If you can take something from a 2-bedroom to a 3-bedroom, or a 2-1 to a 3-2, you immediately add value to it. So we did that. We converted 2 of the units to 2 bedrooms. So they had a a bedroom, and then that bedroom had a closet, but it had a second closet that was a huge 10 by 10 room. And so you can't really add another bedroom that you have to walk through a bedroom to get to. So we closed it off, and then we added it as a bedroom to the unit next door. We did that on 2 of them. So that also allowed us to bump up our rents, which increased the value of the property. And then we added back doors. You got a back door here. That one's a back door. So, and then we still need to give them backyards, but that's kind of our long-term plan for keeping these tenants. You don't see many one-bedroom apartments that you can have your pets and have a backyard. If you think about one-bedroom apartments, they're going to be, you know, multiple stories, and you'll have to walk down all these stairs, and then you take them outside. You don't have a yard. So they're each going to have their own backyards. We already put in the back doors. Just need to finish up the fencing. So just a couple of other ways, other creative ways we could add value that weren't just numerical. All right, so quick review on this. How to do a value add. You take the net operating income divided by the cap rate. That's the value of the property. If you can increase this number, you're adding value. If you can make the cap rate smaller, you're adding value. You can't really affect the cap rate. The cap rate is affected by the market. So you got to focus up here, and cap rate is just based on timing of the market. All right, so we're going to run through this scenario. I'll make sure we end on time. So I'm going to illustrate a property, and in this scenario, this is going to be as if y'all were looking at a multifamily property and wanting to analyze it and say, does this have potential? Could I add value? Could I build equity in this property? So this one's 25 units, all 2-bedroom, 1 bath. Okay, so start thinking about what you know about 2-bedroom, 1 baths, 25 units. So the market rent is $180,000 or $15,000 a month. Yeah, $15,000 a month. It's 80% occupied right now. So this is you looking at this deal of, okay, will I buy this deal? So the actual income when you take out the vacancy is $144,000. You got property tax, $20,000, insurance, $12,000, maintenance, $30,000, property management, $18,000. I like to look at maintenance and property management as percentages. So what percentage of this income is the maintenance and property management? Marketing, admin, and utilities, they're paying $15,000 in utilities on this property. So if you take that top line, you subtract out all the expenses, the net operating income is $48,000. We're going to use a 10% cap rate just because it's really easy math. 10% cap rate, this property today with its performance is worth $480,000. Okay, so looking at this deal, who would be interested in buying this at $480,000? Scott? Okay, Jim would. What about $700,000? Who would be interested in buying this one at $700K? Scott would. Jim, no. Jim's out. Jim was in at a lower price. Scott was in at a higher price. So Scott, you'd pay more than it's worth right now. Why?
Can't buy anything else comparable. I pay $30,000 a unit, getting 500 rents based on that. Like again, the rents are low. Maintenance seems high.
Yep.
Management seems a little high. Utilities seems crazy. I don't know what they're paying, but your rents seem to be $500 a month or less for
$600 a month. Yeah. Yeah. For a 2-1. He just analyzed this entire deal in his head like that fast. And Scott can do that because he's done value add properties. I know he's got one going on right now that I tried to buy, that he bought, that he's doing a value add on. So once you get repetitions on this, you see it. So he saw, okay, this is like $600 a unit and they're 2-1s. That should be higher. So there's.
Okay, where is it though?
We'll say it's in a decent area in the middle of town.
Okay.
I mean, even if it's the worst, my units are, we're renting it right now at 600 remodels. That's probably the worst, cheapest, worst area of town. And then
2-1s?
2-1s, central heat and air, all redone, $600 a month.
That's cheap.
we're getting them.
It's a rough property.
We've still got like 25 empties, so
Okay.
we'll adjust them in a year. But
So let's say it's a good area, east side-ish.
Okay.
that side of I-27, and just south of 19, Chapman something.
Chapmanville area there. Okay.
Yep. All right, so Scott, you pointed out the rent is low for a 2-1 in a good area, we'll say. No balks at these. Property tax and insurance, they seem fine.
We didn't, so we bought it and the guy didn't have a loan on it. We weren't familiar with Lubbock. We're getting killed on insurance because it's in a flood zone. Our flood insurance alone is like $15,000. We did not prepare for that.
Maintenance seems high. So I look at things as percentages. Maintenance is over 20% of the income. That's way too high. Should be, in my eyes, it should be between 10 and 13%.
But that might be a good thing if they're taking care of it.
Maybe.
I hate when I see that it's zero.
Yeah.
How's it been zero for a year?
And then utilities at market rent. If you're not renting them for way above market rent, then the tenant should pay utilities. If you get way higher than market rent and it's all bills paid, then that's why. All right, so what happens if we just change those numbers that he pointed out? You pointed out every single line item that I was going to change. So you get these up from $600 a month to $800 a month. So the income goes up to $240. You get the occupancy up to 90%. So your top line goes from $144 to $216. You get your maintenance costs down a little bit, a little over 10%. Property management stays the same. And then utilities come down. You'll pay some utilities because you have to turn over the units, but those came way down. Net operating income is $141,000 on that example. This is a very realistic example, by the way. 10% cap rate. This property is now worth $1.41 million. Before, it was worth $480,000. So who would potentially buy this one for $700,000 knowing this? Which, that's kind of the thing with multifamily, is that you usually are paying higher than today's values, but lower than tomorrow's values on it with the value add. So when we look at something and we're like, today it's worth $480,000, we're probably going to be buying it for more than $480,000, because you do kind of get to sell these based on some of the potential. It's more educated sellers, and they're going to know, hey, you could do a value add, there's upside here. So you kind of pay usually somewhere in the middle of what it's worth today and what you could get it to.
Which would have been $1 million.
Mm-hmm. Yep. That would have been a big value add. And that's a 25 unit property. It may seem out of reach, but that's something that people in this room have the potential to do. You just have to be able to kind of eliminate all the variables of that type of deal. But you could add almost $1 million in value just by increasing the performance. So this is also from our appraisal of my property, back to the one we just did. We bought it for $645. It appraised for $1.15 million a couple weeks ago. So through raising the rents and a couple other things, we added $500,000 in value. Again, we bought it from a guy that had done his own value add. He had added his own value. So there's still opportunities, even if you're buying from other savvy investors. They just may have taken it as far as they want to take it. So with that, we're getting a new loan of $920,000 from the bank. Our cost with lenders, fees, and all that stuff is $830. So we're going to get a cash out refinance of this one. We'll get $90,000 out of this property based on today's value. This is, like I said, from our appraisal. That's what they said it was worth based on the 8% cap rate. So this is how multifamily can be like just printing money. All right, so that's today's value, right? It has a $92,000 net operating income. Again, like I said, they use an 8% cap rate from our appraisal we just had done. So that's how they came up to $1.15 million. You take 92,000 divided by 8%, 1.15 million. Where multifamily can print money for you, now you can likely only do this one time because cap rates are going to fluctuate. So when the cap rates go back down, when interest goes back down, it may be a couple of years from now. So we're happy with where we got it to today. We hit our numbers. But let's say we don't change a single thing about the net operating income. It's still $92,000, but the cap rate goes down just to 6%, which is very, very feasible that that's going to happen in the next few years. We changed nothing about the property. Cap rates go down. All of a sudden, this property is worth over $1.5 million. And now at that time, we could either sell it for $1.5 million because that's what the market says it's worth. We could do another refinance and take out another few $100,000 and still cash flow at the same or close to the same, because at that time, if the cap rates are lower, that means interest is lower, and we can get lower interest on our loan and pull money out while keeping the cash flow. So if you, yeah.
How much do you have to put in to get the loan up for the first few apartment loan for like 95% of like renovations plus your down payment?
I got the whole thing funded.
100%?
Mm-hmm.
Talk about that, man.
It's a private lender. Yep. So now you can only do this once because cap rates will dip down. You do a cash out refi, boom, you collect what it's worth. Now the only way to do it again and pull more equity out of the property is if you increase the net operating income. But cap rates will go down, they'll go back up. So when they go back up, the value is going to be less. So you can do this, you know, whenever the cap rates are lower.
Over the next 5 years, you'll pay it
Yep.
down.
Yep. So the principle of buy low, sell high, if you're looking at cap rates of the market, you want to buy when the cap rates are high and sell whenever the cap rates are low. Because you see this same property, nothing changes about it. Right now, the cap rates are relatively high. And so that's what it's worth today. So you want to buy whenever cap rates are high and then sell whenever cap rates go down. And that adds value to the property doing nothing else. Like if we had just not touched this and bought it with a higher cap rate and waited till cap rates went down to 5% and sold it, we would have a ton of equity because that's part of how you value multifamily.
Are cap rates only relevant on like 5 plexes on above? Is that what the number is?
Yeah, at least from what I've seen. I have had a quadruplex be evaluated like this with NOI and cap rate, but most of the time it's 5 and up.
Is that the A1 plus zoning? Anything A1 plus?
I don't know anything about zoning. What other questions do y'all have? We're almost out of time, but
I gotta say something real quick. I remember this deal last year. You talked about it. So it's been between aggressive and conservative, and I gotta hand it to you. Did a really. I was scared because right at the corner, 19th and Milwaukee, there was like 150 of those units, just like that. And you told me a little kid was like, "Get the hell away from you!" And you still went after it. You still did it. You still made it work. So kudos to you, because that scared. I was like, "Oh Jesus, Christ, the building some in there." And I just felt like, no matter if the guy was giving it away for $1, you know what I mean? It's got to be a challenge.
Mm-hmm.
We're still going after it. So
thanks. Yeah. All right. We'll wrap it up. We can talk more. If y'all have any multifamily deals you want my opinion on, if you're under contract or whatever, I'll try and help you out how I can because they're kind of intricate. Single family deals for that matter too. If you need help and just get over the hump.
Pay for them.
Hey, you got a deal on that one today, so, and you were the only one that wanted it. It's cool. So we'll get back together next month. That'll be May 16th. That'll be here before we know it, but we always meet on the third Tuesday at noon. So somewhere for lunch. We've been coming here a lot at Giorgio's, but there's my contact info. I'll send these slides out and the recording, and see y'all next time. Thanks.